Hello, everyone. Today on the final bar, my guest is Willie Delwiche from Robert W. Baird, joining us from Wisconsin. Looking at the markets today, the S&P rallied into the afternoon hours yesterday, just before 3 o'clock, obviously sold off pretty quickly. Today has been all about reclaiming those previous highs. We didn't quite get up to the peak from yesterday, but yesterday's pullback all but swept away as there's plenty of resilience, lots of strength. What does this mean for the long-term picture? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller, the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the market activity through the lenses of technical analysis, behavioral finance, and any other tools we can bring to bear. We have a great guest today with Willie Delwiche, and what we'll talk about is essentially just the characteristics of this market. Later in the show, we're going to have a segment, Banking on Breadth, where we focus in particular on breadth characteristics and how they're evolving. And I think very quickly what's happened in the last couple of weeks is you've gone from breadth measures looking very negative and really not confirming the early September high. That's now sort of alleviating. You're seeing breadth measures improve a little bit more. So bullish percent index is looking less negative. Advanced decline line starting to turn higher. We didn't quite get a 90% up day, but we got pretty close. And so, and the new highs list is increasing. So you're starting to see, even though the S&P has not been able to really break above the swing high from mid-September, individual stocks are starting to be able to do so. And I think that's worth noting. Now, I mentioned Willie Delwiche from Robert W. Baird joining us very shortly today. Later, Thursday this week, we have JC Peretz from All-Star Charts coming back to the show. Next week on Tuesday, one of my early mentors, Jeff Weiss from Clearview Trading Advisors, is going to join the show. And then on Wednesday, Mark Newton from Newton Advisors coming back to join us as well. So we have some excellent technical and strategic content and experts to bring in front of you over the next week or so. We're very, very fortunate with some of those guests. Now, when we look at the market recap, as I mentioned, I'm actually a very optimistic person in general. In life, I tend to be pretty happy about things. And I think my market analysis tends to have a little more of a negative tilt to it, and mainly because I learned technical analysis mostly in the years 2000 to 2002. And so my introduction to charting was all about risk management and looking for breakdowns and looking for downside, because all I saw as I was learning how to chart, it was as things were, the tech bubble was popping and 9/11 was happening, all these things were unwinding. So I am usually a reluctant bull and, looking for signals that things are getting worse. So I was super, intrigued by the weakening breadth characteristics going into the early September high. And I think that's, served us well as we've talked about that move down to 3,200, looking at a chart of the S&P here. So, that swing down made sense. That line in the sand made sense. We didn't really break down through it. And since then, I think one by one, you're seeing the negativity that made that first half of September, really through the first 3 weeks of September, seem so not obvious, but certainly seem so meaningful, have all been alleviated, right? So we're below the 50-day moving average. Now we're back above it. We're, testing support holds. We're breaking back above, recent swing highs. And now it's this 34.25, 34.30 level, which is the swing high here from early September. We didn't quite get above it. So I think that's the last signal that I'm waiting for, as we've talked about. And as I promised, I'll be the first to tell you S&P 3,600 should be an expectation and a reasonable one at that. The breadth picture is what's been improving so much. And I think that's what we're going to look at a little later in the show, is really go through each of the breadth charts one by one and see how they've evolved. But I think at this point, I have to assume that, 3,200, this range, this blue area that I've highlighted, certainly seems to be valid support. We've talked about being in this range between 3,200 and 3,400. We're testing the upper end of that as we test these resistance levels. If we break that, I think we're ready to go meaningfully higher. We may be there now, and I think the breadth picture is improving enough that it's starting to seem more and more possible. just to regroup on what happened today, the S&P closed up 1.75%, just below 3420. Mid caps and small caps also up, but the S&P and mid caps really led the way. Small caps lagged a little bit behind, but overall still all very much up. The Nasdaq led the way, further outperforming the S&P, and the VIX is down just above 28 today. On the bond markets, my guest yesterday, Jay Hatfield, we were talking about potential weakness in the bond markets. That there was a spike yesterday after Trump's comments about the stimulus package, but today you've seen bonds come back down, sort of as Jay and I were talking about on yesterday's show, and yields moving higher. On the commodity side, gold essentially finished flat, and silver was much of the day in the green, finished more positive than negative. Looking at sector rotation, that move in materials, which had been so impressive, and then all of a sudden started to look less impressive, really has reaccelerated. This is a really interesting chart because this is an example of where there's a bit of a failed pattern here. You could call yesterday a bearish engulfing pattern. Let me zoom into a 6-month chart, and we'll do the candle charts, make it a little easier on the eyes here. So, a bearish engulfing pattern is when you have a run up in price, and if you assume that this was a run up, a 2-week uptrend, you have an up bar, an up candle, and a down candle, and the second day's candle engulfs the first day's. That's a bearish engulfing pattern, suggests short-term weakness for the next couple of days. Talking with Steve Nissen years ago, I thought of it very simplistically for a while and just sort of followed that. And he said, that's okay, but your results are going to be much better if you use the candles as part of more of a system and pay attention to the levels. And what I remember him telling me is we break above the high of that second bar, that invalidates the engulfing pattern. Same thing if you have a bullish engulfing pattern and you break the low of that second bar, that sort of invalidates it. So I think today on the materials sector, we invalidated that sort of short-term negative signal, and this is certainly following through to retest previous highs just below 67, which is an impressive run for a sector that started to look a little relatively weak. I'm certainly starting to chip away more on the upside. Consumer discretionary number 2, and we talked on Monday's show on all the improving charts with the consumer discretionary. That's certainly not a surprise. So materials and industrials, 2 sectors that we'd all but written off as sort of struggling in early to mid-September, now reaccelerating today. On the downside, you have some of the defensive sectors like real estate and utilities and consumer staples, but also communication services, which is a bit of an outlier. You'd normally assume that to be more on the upper end, given the offense in some of those sectors and some of the recovery themes that we've seen. In terms of groups and what sort of movements we've seen, again, we're going to talk a little bit more about breadth later, so I don't want to, hit on it too hard right now. But looking at some of these sector or group themes, the top one is renewable energy equipment. It's actually an interesting sector. We're debating internally where to put it. This includes solar names, hydrogen names. It's a mixed bag of sort of new energy types of things, and most people struggle with where to put it. You could put it in energy, which is what we currently have it bucketed. You could put it in technology and industrial. So it's sort of a weird, doesn't really fit into most, structures of looking at sectors and industry. But that group is up 8% today. It's the number 1 out of all the Dow industry groups that we follow, breaking to a new swing high. So it might be worth digging into some of the names on there. We looked at them earlier in the week, if I remember right, looking at some of the components in there. Also within the materials sector, 3 of the top 10 within there, including steel and aluminum and non-ferrous metals. Airlines, another one on the top. And again, I'm always a little skeptical of something like airlines, a lot of energy groups, because when they're coming off of extreme low levels, 1-day percent moves are impressive, but a sustained percent move and especially the outperformance that could come with that is what's most impressive. Compare that to something like auto parts, and I'm focusing on the little preview charts there as I'm talking. I hope you can see those okay. But the auto parts, jumping to new swing highs. So things, not just up on the day, but breaking to new swing highs. I think from a technical perspective, more meaningful than otherwise. In terms of groups struggling a little bit, half of the bottom 10 groups are all within real estate, all REITs and REIT plays. Gambling was the worst group out of the 100 odd Dow industry groups, and And again, that's sort of that's been the reopening play. You've seen times when gambling stocks have done better. Some of the gaming stocks like MGM and Las Vegas Sands and others like that. But you can see it's coming off a little bit, coming off of a swing high around 700, and so well below its previous highs from early September. It's really come off pretty well since that previous peak. Very quickly, I just wanted to hit on one other chart as we get into the measures of breadth. We'll hit on a little more of these in detail, but I did want to pay attention to some of these ratios. Staples are actually improving here, but also consumer discretionary, one of the top groups. And this ratio chart of consumer discretionary versus consumer staples has not quite made a new high for the last 12 months, but it's very, very close. And traditionally, you think of this as offense versus defense, right? If consumer discretionary outperforming, that's more of a lean into the offensive side of consumer, and if it goes down, that's more on the defensive side. It bottomed out in late September, and since then is now retesting previous highs. So certain measures of offense are actually, accelerating and going to new highs. This one not quite yet, and it's interesting that the most compelling chart, we looked at P&G, Procter & Gamble yesterday within consumer staples. Pretty decent chart. It looks a lot like this ratio chart and performing pretty well and holding up very, very nicely. It's not broken down really at all. So some interesting dynamics behind the scenes. I think when we get to my guests here momentarily, we're going to talk about some of those relationships under the hood within the equity space. So let's take a break now. We'll be back with my guest, Willie Delwiche from Robert W. Baird. We'll see you in a minute. Hello, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. I want to thank you for joining us every weekday for our Closing Bell show. As a reminder, we love to hear from you and answer your questions during our mailbag segments. We'll do another one at the end of this week. So shoot an email to us with anything on your mind, anything that comes up in the normal course of looking at the charts, thinking through different potential scenarios and how we can help. Shoot us an email, thefinalbar@stockcharts.com. or on Twitter @FinalBarSCTV, or finally on any of our YouTube videos, just put a comment right below the video. We'll capture all of those and hopefully answer one of your questions in our next mailbag segment, end of this week. I want to welcome on my guest back to the show, Willie Delwiche from Robert W. Baird. We were talking earlier just about the dynamics of the market, and Willie, looking forward to having you back and hearing your take on this environment for sure.
Thanks for having me, Dave.
So your first chart is really looking at small versus large and looking at a relationship that we've talked about a lot. I mean, and a lot have speculated on small cap relative performance, what we should be looking for and what we've seen. Talk us through your perspective on this key relationship.
Yeah, sure. So just by way of background, the chart here, the top line is just a ratio between the S&P 600 and the S&P 500. So just index level relationship. The bottom line there, that breaks it down by relative leadership at an industry group level. So what I do, I rank all the industry groups in the S&P 500, 400, 600, and then kind of cluster, how strong are in aggregate our large cap versus how strong in aggregate our small cap. And so the idea here is to not just look at index level relationships, but look at industry group level relationships. And the key here, a couple of them. One, prior to the weakness we saw in small caps earlier this year, as we went through the bear market related to COVID, if you look at the bottom, from a relative leadership perspective, we were seeing improving small cap strength over the course of last year, and that really continued in the first part of this year. We didn't make a lower low from a rankings perspective, if you will, and so then we had a recovery. We rallied. Some of the weakness we've seen in September, that's reflected at the very end of this line. We saw small caps really start to get get hammered. If the strength we've seen over the last week, not just with small caps, but with the market in general, is sustainable and is something that we're going to build on, keep an eye on this bottom line that should start to move higher and should start to move higher pretty quickly. That's a sign that we're not just stuck in the S&P 500 rallying and everything else lagging, but really seeing, I think, a continuation of what we've seen now over the past almost year and a half, 2 years of this trend that's been interrupted somewhat, but this trend of small caps finally starting to show some leadership relative to large caps. And that would be encouraging for the economy, encouraging for the market, a sign that we're not just stuck in, 5 stocks driving everything and everything else gets left behind kind of market.
Right. And really, I would guess, right, it sort of indicates that you would think institutions putting their stepping on the accelerator a little bit and putting on more of the higher beta, speculative plays.
Yeah.
Having said that, your second chart is starting with a good look at breadth, looking at the equal weighted index. Talk us through chart number 2.
Yeah, so we spend so much time focusing on the S&P 500, and we it made higher highs earlier this year, and then peaked in early September. And the question that I come back to a lot is this just a handful of stocks that are driving it, or are you seeing broad participation? And so one way that I gauge that is to look at this chart. It's we look at the equal weight S&P 500, the broker dealer index, typically a good leading indicator for the market overall, and then we want to keep an eye on what's going on overseas as well. So we put the German DAX in there. And the key here is a couple things. One, these indexes remain below where they were earlier this year. So yeah, the S&P 500 made new highs, but there's a lot of areas of the market that did not get back to those new highs. So we can keep an eye on that as we move through the fourth quarter. If that starts to change, then we'll maybe have a bit more sustainable strength than that move that we saw in August that quickly got reversed in September in the S&P 500. The other way we could, these are just a straight index. You could look at these relative to the S&P 500. I don't have it here, but you can do that, and you can start to look. If we're seeing a sustainable move higher, we should see leadership from each of these areas. We should see the equal weight index start to outperform the cap weighted S&P. We should see leadership from broker dealers. We should see the stocks around the world at least hold steady and maybe even move into the lead relative to the S&P, just given the underperformance the global equity market has had relative to the S&P 500 over really the past 10 years. And if we get that, and I think you made a good point, Dave, that first part of September, it was looking bleak, but the last week or so, things have really started to turn around. If we can build on that, and you can see it on the charts, they're starting to move, they're starting to turn higher. If they can take out their September peaks and then start to look at their February peaks, as broad as we've seen in terms of small cap participation, we might not be, and I don't know if I'm stealing any thunder here, but we might not be that far away from another round of breadth thrusts that we saw earlier this year. We could be set up for that as we start to move forward, and that would be really encouraging from a cyclical perspective as well.
That's a great take, Willie, and 2 fantastic charts. The second one, I feel like I want to put it on a list and keep my eye on it, because it's a great sort of macro view on some of the key signals that might illustrate an all clear of sorts. Willie Delwiche, thank you so much for coming back on the show. Good to hear from you. Hope you and your family stay safe there in Wisconsin.
No, thanks a lot, Dave.
That's Willie Delwiche joining us from Robert W. Baird. And again, I love his take on just broad things to pay attention to. It's so easy to get caught up into the idea that the S&P 500 is the market, which again, if you're using a passive product and you're, just in the spiders or something, then that's fine. That's how your performance is going to be illustrated. But if you're managing your investments actively, if you're managing client money, if you're at an institution, the goal is to obviously do better than that. And the S&P is arguably not the perfect measure of everything. There are other ways that you can, look for pockets of opportunity, look for performance, look for, inflection points. And I think some of those indexes and areas that Willie identified are pretty helpful. Our next segment is called Banking on Breadth. We use breadth pretty often on the show. A lot of the charts that I refer to sort of, come back to breadth, because for me, as we've talked about many times, my macro discipline starts with price, and then it goes to breadth, and then it goes to sentiment. Number one is, what is the price doing? Are we in an uptrend or downtrend? And that's the number one question I think investors should be trying to answer on anything that they're looking at. But then breadth and sentiment help you qualify that price. And I have often found, especially at major turning points, the breadth picture changes before the broad market changes. And that's one of the things that served me well over the last 12 months, identifying in the February peak, or even here in early September, identifying, weaknesses in breadth that spoke to some internal challenges with the stock market making newer highs. So let's walk through some of the key breadth charts. This is part of the breadth chart list that I've created. If you have a StockCharts login, if you go to your member dashboard, your dashboard, and go down to the chart list section at the very bottom, there's a link for chart packs. And this one is called the morning coffee routine. And it includes this chart list we're going to be using here right now. The first chart is looking at percents of stocks above their 200-day moving average, and it's two different baskets. First is the New York Stock Exchange here in green. At the bottom, it's the S&P 500. What percent of those index or exchange members are above their 200-day moving average? What's interesting is, I think, speaking to some of Willie's comments about the S&P, right? 65%, 2/3 of the S&P currently above their 200-day. It's only 56, 57% of the New York Stock Exchange. That just came back above 50%, actually had gone below 50%. So, the S&P as a group has been doing better than sort of the other names, the smaller names, mid caps and small caps, which makes sense. That's sort of some of the charts that we've been looking at, especially in the month of September. You saw how it was favoring large caps again to a little degree. That's reversed now, and now you're seeing both of these starting to move higher. And I think one of the key parts of the bullish thesis is getting this breadth measure to remain above 50%. That takes us to our second chart, which is just breaking the S&P 500, the same line, percent above the 200-day. And here we're looking at percent above the 50-day. And I think one of the challenges that we've seen, especially going into this market peak, you can see how, the market going higher into the September peak, but, there weren't any more companies going above their 50-day. There are actually more companies starting to break down through their 50-day moving average. And here in mid-September, it actually flipped to less than 50%, meaning most stocks, just like the S&P, had gone below their 50-day. That's actually gone back positive. So the S&P back above its 50-day, this indicator back above 50%, which means most S&P members have remained above their 200-day and now back above their 50-day moving average. In any sort of pullback and any sort of retest, seeing where this is, and if we continue to make lower highs and lower lows, would be a key part of a bearish thesis if that would play out. Here we're looking at advancers, decliners. We look at it in a cumulative fashion pretty regularly as part of our normal weekly routine, but here we're looking at the daily reading. As of today, and again, this changes usually as we're digesting all of the closing bell data, but overall, about 3 in 4 stocks on the New York Stock Exchange closed higher today rather than lower. What you'd want to see, I would argue, if you were a raging bull and you want a retest of 3,600, probably most people do want that, but if you're expecting that, I think what you would like to see are 90% up days, which is more characteristic of a bull market environment. You see that coming out of the lows here in March and April. It sort of suggests, everything's going up. It sort of felt like that, but there are plenty of stocks, 1 in 4 that actually closed down on the day. So it's not a 100% or a 90% up or down. So at this point, it's still not quite sort of the all-in performance read from individual names. A lot of these measures, I should point out just to clarify, are not quite updated for today yet. So you'll see them update in the next hour or so. So here we're looking at stocks making new 52-week highs and 52-week lows. This is not updated yet. I would anticipate this number will continue to increase as we digest the closing values. But as of yesterday, you can see we're getting an increasing number of stocks on the NYSE and members of the S&P 500 making new 52-week highs. This is something we've talked about that we haven't seen yet in terms of a big influx of new highs. You need stocks like P&G and home builders and others like that, making new 52-week highs, eclipsing their previous highs, which the S&P has not quite been able to do. You need to see that more and more to validate potential for further upside. You need to have the leaders sort of leading the way before the S&P does it. We're starting to see that, and as that line increases, my confidence in further upside is certainly going to increase as well. Please ignore the color coding. I don't keep this one updated as much. I would probably color code all of these amber at the moment. I might make the S&P one green though, so that's probably valid. The rest of these I probably color code amber because we're sort of within this range, right? I'm always looking at the cumulative advanced decline lines, whether we're making higher highs and higher lows. I think what's compelling though is all of these now have broken above their swing high, the most recent swing high. So they've gone from a pattern of lower highs and lower lows to at least higher highs. You want to see on a pullback if we continue to remain above this previous swing low, but the S&P's actually made new 52-week highs. Out of all the charts we're going to look at, this might be the most constructive because while the S&P is below its early September high, the S&P advanced high for the year. And so what that tells you is underneath doesn't tend to be a bearish event that you see that. The bullish percent index is back above 50%. This looks at the percent of S&P stocks in uptrends or downtrends using point and figure charts. Back above 50% is bullish. When this went negative, this was part of our overall, things could get a lot worse. We've now bottomed out right where you'd expect support at previous support. We've now bounced higher, and these breadth measures all starting to sort of, turn higher. So again, at this point, we're waiting for a price break to new highs, but overall pretty much okay. We only have another second or two. The McClellan oscillator, very similar to the bullish percent index, back above the zero line. The summation index has remained above zero and starting to flip higher. So overall, I think looking at the breadth picture, it's gone from negative to now, and negative to bearish to now negative to positive. It's sort of, rotated a little bit. And I think seeing continued improvement in some of those key breadth measures would be a big argument for a return to S&P 3600 or any achievement of S&P 3600. We need to wrap the show, folks, and go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is looking at the S&P with the percent above the 200-day, percent above the 50-day. We reviewed this just moments ago in our breadth indicator review, and I just want to highlight this fact that in any sort of pullback, I'm looking at these two indicators. Are they remaining above 50%? When this one turned negative, when over half of S&P names were below their 50-day, that started to tell me that there was the potential or an increased potential for further breakdown. Support held, and now we've bounced off of it. The S&P back above its 50-day. And this indicator on the top, the percent above their 200-day, never got below 50%. And if things would really get bad, that would be the indicator that would confirm to me the potential for further downside. We haven't seen it yet. Chart number 2 is looking at the S&P and stocks making new 52-week highs or new 52-week lows. And some of these are just updating. I think we had 42 members of the S&P, which is, 9%, 8.5% of the S&P, which is a pretty decent number. That's actually improving pretty well. So a continued increase in these indicators telling you that individual stocks are making new 52-week highs. That would, I think, further validate the potential for S&P 3600 going into year end here. And then chart number 3, to wrap up our 3 and 3, we looked at Procter & Gamble yesterday, PG within consumer staples. Today, I'm highlighting Caterpillar CAT, just hitting on a stock that's holding up well. That's never broke down below its 50-day. It's above 2 upward sloping moving averages. So I think from a stock picking perspective, there are stocks that are holding up just fine, even with, at times when the S&P, when with the NASDAQ, when broad market conditions have felt potentially dangerous, when we know all the macro headwinds to further upside in the market, when we hear comments and everything. But again, charts like this that hold above an ascending 50-day moving average, making a new 52-week closing high again today, that tells me that there are pockets of opportunity and more broader opportunity. Caterpillar, obviously within the industrial sector, that industrials materials trade is one that I would certainly be looking at if you're not there, because that's a development that emerged. It sort of cooled off and now potentially re-emerging. Folks, that is our show for today. Thank you so much for joining us every weekday on the Final Bar. Special thank you to my guest, Willie Delwiche from Robert W. Baird in the Milwaukee area for joining us on the show. Some fantastic thoughts on a key broad market chart or two to pay attention to. We'll do another mailbag segment later in the week. Shoot us an email, thefinalbar@stockcharts.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.